What's up? I'm Dan Fredenberg, and this is another Chance Encounter.
Hey, what's up? I'm Dan Fredenberg. I'm a commercial real estate guy. I'm from the internet. We're seeing more properties like this being built in front of a house that's going to be torn down soon. I understand that there are power lines that are getting kind of close. What's up again? This is Dan Fredenberg, and that there is a commercial real estate building.
I'm joined today with Bryce Stewart. How are you doing, Bryce?
I'm doing great.
Awesome. Great to have you. And I'm very happy today. I got to tell you, Bryce. And the reason is because I've got my favorite member of the audience with me today. And why is my favorite audience member here? Well, this is a chance encounter. And what I do is I interview commercial real estate investors. Why am I doing that? Part of it is because we have to, but I'm asking them out of the 5 distinct motivations that commercial real estate investors have for wanting to make more acquisitions. I'm asking my guests, well, which one best describes you? What combination of them describes you best? Then I go through the 6 different roles in a commercial deal and I say, hey, what's your core competency? And the real idea is it makes sure that you can communicate effectively on the topic of commercial real estate. And if you want your own die printed out, show it to your friends and family, just go to dandoesdeals.com. It's free. I don't even ask for your email address, which is the worst thing you can do in marketing, but I'm doing it anyway, just for you because I like you so much. But anyway, before we get too far ahead of ourselves, Bryce, can you please introduce yourself to the audience?
Yes, I'm Bryce Stewart. I'm a real estate investor who lives in Bethlehem, Pennsylvania, about an hour north of Philadelphia and maybe an hour and a half west of New York City. And most of my acquisitions up to date have been smaller multifamily deals. The market locally has been good enough that has buttered my bread. And I've built a local portfolio that has allowed me to retire from my day job, feed my family, and then also continue to expand and get capital.
Excellent. I love it. So let's go through the motivations. I always go through the motivations first because sometimes I interview newbies. That was interesting. I hit maximize and it minimized. And then I hit this and then I hit, oh, that's not even plugged in. That's going to cause a problem. Actually, oh, I can cheat. I'll cheat to win. Let's see if I go like this. There it is. Good thing. I love cheating. All right, at least on this sort of stuff. So 5 different motivations. The first different motivations that commercial real estate investors have is they're looking to preserve their purchasing power. So if you are like Bryce and you rely on the cash flow that comes from your assets to make ends meet, your biggest concern is inflation because that cash flow's value is going to go down. So you need to get more sources of cash flow. So that is not my main concern. My main concern is this next one, trading time for wealth. I've got a background in tech. You'd never guess by all the tech stuff that you're surrounded by, but one of the problems of being a high wage earner from tech or whatever it is you're paying more income tax than anybody else. Income tax is the largest form of tax, and so it hit me. Why don't I pivot and accumulate equity instead of the wages first, because that's basically what the name of the game is anyway. But that's my one. But the most frequently chosen motivation that I find on this show is fast tracking retirement. And that means you want to work less each month, each year, each week, whatever it is, each day. But the main idea is that scaling back of your time. Whereas the next 2, they're not going to be scaling back on their time. The first one is going to be because they're so ambitious. They want to buy their entire hometown. These guys are the generational wealth people. Okay, they want to make sure that their great grandchildren never have to hold down a day job. They're that level of ambition. But the last one, some people, they pick a sector of society, or maybe it's animals, or maybe it's the environment, who knows what it is, but they realize that accumulating wealth is by far the most effective vehicle in making an impact on society, so they decide to do this. I like to say that they're trying to save the world. But of those 5 different motivations, Bryce, what resonates best with you? What makes the most sense for you?
They all do ring a little, resonate a little bit with me. I'll say the one that's probably least applicable is the high wage Dodge.
Hmm.
I am taxed very little on my real estate income, but I didn't have a high wage job that I exited when I invested in real estate. In fact, I was a sixth grade teacher at an elementary school. So you could argue that's the bottom rung of the socioeconomic ladder. But even in that, I did see that I was taxed less on my real estate income when I was beginning to invest, but still had my day job. I was taxed less on my real estate income than I was on my W-2 income. And to me, that was a level of clarity that, oh, I need to pour more eggs, proverbial eggs, into this basket because there's a higher incentive to do it.
Yeah, yeah.
All of the other ones do resonate for me to some degree. I would say the biggest motivator for me is to free up my time.
Hmm.
I have 4 daughters who are all in grade school, and no matter how much money I make, I cannot buy back this current decade of my life. And
Yep.
so my desire is to be, I'm coaching girls lacrosse this spring. We took trips with my girls over the last year. We were able to homeschool during COVID. And so these are precious years for me that I know I'm not going to get back if I let them go without taking full advantage of them.
Hmm. Hmm. I
I'm
love that.
already fully retired from my W-2 job, and my entire income is mostly derived from real estate
Real
income.
estate.
I also have a book called House Hacker's Guide to the Galaxy that produces a little bit of income as well.
Mhm.
But yeah, it frees up my time tremendously.
Excellent, excellent. That's a beautiful thing. And I know some people are like, oh, these real estate people, they're not paying any taxes, blah, 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 blah. But they don't even realize that, the government's job is to be stewards of the lands and the people, and they're outsourcing it to landlords. They're literally saying it's like, hey, you guys take care of it because we don't want to. And so, of course, they're going to give tax breaks. It makes sense. I know the founding fathers said
Well,
taxing is a means of destruction.
yeah, but I would say one, real estate investors do pay taxes. We pay real estate taxes.
Hmm.
I pay on that metric. I pay more than most people I know in taxes.
Hmm.
Um, I would also say that instead of it being quote unquote incentive based, really the largest piece of tax advantage in real estate investing is depreciation. And depreciation isn't necessarily the government incentivizing investment in real estate. It's just how business accounting works. The IRS had to pick some number of years as the depreciative lifespan of real estate.
Hmm.
They're obliged to do that just to set boundaries, and in doing so, they whether they wanted to or not, it opens up the depreciative umbrella for real estate investors to not have their cash flow income taxed.
Hmm.
So there's really no way around that. That's for any business. If you have a if you own a business and you have computers, all of your computers will have a depreciative lifespan. All of your office furniture will have a depreciative lifespan. That's just how accounting works, and real estate works the same way. It's just one of the reasons it's so advantageous in real estate is because you can leverage so well with real estate that
Hmm.
the assets depreciating at such a high clip that it's going to eclipse your cash flow income for taxability purposes. There's very
Exactly.
few other investments that you'll have that same ratio and therefore have such a high depreciative level in the beginning.
Hmm. 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 Yep, I love that. Yeah, it's and when it comes to big buildings, they have big expenses, and so you better have some cash flow lying around when something goes terribly wrong, because it's not like insurance just pays that night.
Right. And even if you don't, like in my case, when I started out, I did not have a war chest to
Hmm.
cover stuff that came up. I was still entitled to just the general depreciation that the IRS applies to residential real estate.
Hmm.
27 and a half years straight line depreciation on
Hmm.
a very large asset means I'm entitled to a significant tax break every year that
Hmm.
for the most part eclipsed my cash flow income.
Beautiful, beautiful. So let's get into the different roles. Again, if you want to have your own Dan Does Deals commercial roll die, just go to dandoesdeals.com. It says print out your own die. But let's go through these just so that you can learn how to effectively communicate on the topic of real estate. So the 6 different
Yeah.
roles. The first one is a repositioner. A repositioner looks at a whole whack of different properties. And what are they doing? Well, the first thing they're doing is they're using, it's a fancy word, it's underwriting. They're doing the math to make sure that the building is actually making what the current owner says that it is, but they're also thinking about how can they change things around a little bit so that they can find more upside. And what are the big tools in their tool belt for upside? The first one is more efficient operations. You stop those Benjamins from clogging these toilets, but there's more than just unclogging toilets and collecting rents. There's also, my background is in marketing and digital marketing, so keeping the vacancy rates low is a big part of operations that some people don't think of. But right now things are so competitive, efficient operations probably aren't enough. So the repositioner, in all likelihood, they'll get a contractor team to do some upgrades or value add or renovations, whatever you want to call it. And that way you can actually charge more in rent, and that is upside. But if you are on the internet like me, then you have to have a local. You have to have boots on the ground, somebody who can be there in an hour or two, because that's not going to be me. I'm from far away. I'm in Canada where all the snow is. But if you lined up all of these people in a row, showed them to the tenants, they'd probably say, oh yeah, those are all the owners. But of course, it's not that simple. The banks have to get their paws into everything. So they go to the financiers, you go to the bank and you say, hey, I got this property in mind. Here's the team. I got all that in line. Lend me millions of dollars so I can buy this thing. And they're going to look at all these people and say, no, hang on. There's one thing missing. Who's the sponsor? Who's the KP? Okay. And what that means is, even if you're Elon Musk, if you want to buy, let's say, a 350 unit apartment complex, you need somebody in the fold who already owns a similar asset, or you will not be eligible for the loan. You also need to produce a certain amount of liquidity, and you also have to have a balance sheet of at least the amount of the loan. But if you have all of those pieces, you've got yourself a commercial real estate deal. So Bryce, as far as core competencies go and what you're most likely to contribute to your next deal, I know that you do a lot of solo work, but if you were to team up, what do you think you'd be contributing from the die?
So I'll just speak personally at this point in terms of my own journey. I'm already cash flowing more than enough from my local portfolio to make myself happy, to probably pay for college for my daughters, and to live a very comfortable upper middle class lifestyle. And so the prospect of gaining more chores is, I don't like that prospect. In fact, at my current stage, I'm looking for things that will make me more money without adding more chores to my monthly or weekly plate. So in that regard, I'm probably most likely to be a limited partner contributing to a deal, or I could even, I have a net worth that could maybe move the team's net worth total past the marker that it needs for balance sheet to get approved for a loan. I do have insights, I think, I've done significant renovations to my local portfolio. So these are 120-year-old buildings. I've done historic renovations, and I've essentially overseen, I've been the general contractor, or I've overseen the general contractor. I've sourced subs. I know how to call out bad work, or to figure out very quickly if a GC is going to be able to know what they're doing. And then also I can contribute to the underwriting team. I think there's a lot of underwriters who maybe have had their toes in the water the last few years, where the trailing 12 or trailing 24 for the asset is a reasonable prediction for what the next 12-month period will be. And I think we've reached a point now where that's no longer true. You look at the T12 for an asset, and it does not have yet baked in the inflating cost of labor for either the property management team that's in place, or the contractors or handyman men that they will be resourcing. Just plumbers are more expensive and will be more expensive this year than they were the last 2 years. So if you're trying to get a deal lined up and you're using backward-looking underwriting numbers, you're going to be in trouble when inflation hits all of the labor and materials that you need to maintain the asset. So I know there's some good underwriters who are baking that in, but it's hard to nail down. You don't know how high it's going to be. And so it actually, in a time when people are overpaying for assets, they're overpaying on the basis of the T12. Think about how much they're overpaying now if they hit inflation numbers on the next 12 or the next 24 of their hold period, because it costs way more than they thought it was going to. Now they can't give out prefs, they can't meet preferred returns, and the whole thing collapses in on itself. And I would say even syndicators who were in the game before 2007, 2008, and could argue with you that they've seen one market cycle, or they survived 2007, 2008. This is different. There was not the inflation numbers in 2007, 2008 that we're seeing now, especially surrounding the trades and the material increases that are particularly relevant to multifamily. So it's a tough environment, and I get it. The one thing that is better now is that money is cheaper than it was in 2007, 2008. So you get a little bit more padding there if you have your financing fixed. But you could also be in trouble if you're counting on being able to refinance at the end of a 5-year term, and rates are going to be a point or two higher, and cap rates are going to be higher, and so the asset value won't be there, and you're stuck without the ability to even refinance in 5 years. That's how you get into trouble.
Yep. And that's a beautiful state of affairs as far as what a mixture. I'm sure we've totally been a huge mood booster for you today, but let's get back to
it might mean there's deals coming down the pike if you have lots of cash.
Oh yeah, sure. Yeah, that's the thing. And if you're talking like a 7% inflation, then you got a lot of room that you got to make up for. That's
right.
A tough one.
And all of a sudden I've underwritten deals for the last 10 years. I know what I'm doing. That doesn't mean anything now anymore, does it?
Right. Exactly. I don't know.
That old model.
Right. Whenever I hear people talking about the unprofitability, though, I like to keep on looking back to Uber. Uber, they've never made any money, and they still find money to burn.
Yeah.
And so,
well, you could argue that the inflation, especially in residential multifamily, you can upgrade the rents along with general inflation to sort of outpace maybe the operational costs. But if you're basing the profits, your anticipated profits, on static operational costs and rising rents, you're going to find out that that's not true. The rents can rise, but so will the operational costs.
Right.
You just got to make sure that one is going higher than the other.
Yeah, and inflation is a tough thing for, I think, beginners to really get their heads around. And the simple way that I've come out recently of explaining it is a deployed $100 at 7% inflation is going to be give or take $107 worth in a year. Whereas if you didn't deploy it, then it's only going to be worth 93. So, and that's, just like really simple math, not accounting for, other factors of reality. It's just face value. So I think that's a big thing to understand.
Sure. Yeah, it's a hard one to nail down, and it compounds sometimes along either a supply chain or along a labor chain. Like, for instance, me with my small portfolio, I need to raise rents, not simply to cover let's say the cost of gas, because I provide heat in a couple of my buildings, not just to insulate me against the rising cost of electricity, but also when my insurance premium policies come up for yearly renewal and the premiums are renegotiated. Think about this. My insurance company, who's insuring me against total loss, needs to upgrade the cost of replacing my product if it was burned to the ground or whatever, completely destroyed. They can't leave it at the same number, so they have to charge a higher premium to cover a total loss. Right. So now I have to raise my rents to cover the increased cost of gas, the increased cost of electricity, the increased cost of insurance. And then also I need more profit. Even if I'm just going to stay in the same place, I actually need to increase my profits to protect my own purchasing power after I've paid all the costs associated with my portfolio, because I'm going to end up sending my kids to college, and I have to pay for my own mortgage and my own house and my own cost of living. So those are all the things that I have to bake into. And that's an example just in my small portfolio of the sort of compounding nature of inflation. And I get it. If each of those only goes up 7%, then I should only be raising it 7%, et cetera. And I am hedged by having fixed debt, which is a reason to invest in real estate. But even me, I'm realizing, oh man, some of my re-rentals, I didn't raise the rent high enough to completely cover the gamut of costs that I have to insulate against.
That's tough. So the next part that I always ask is, who's the best person to reach out to you? So in terms of these, the other thing too is, if you're doing any 506B raises, make sure you don't entice any investors. 506C, you can do whatever you want. But as far as the die goes, we're all able to help some people more than others. Me personally, because of my marketing background, I'm always on the lookout for more sponsors and KPs, just because they're the ones who can help scale and level up way more than the others. But for you personally, the person in the audience there, who are you really hoping reaches out to you?
So I would be a good member, I think, of a general partnership team. It would be my first one. I have to be honest, I haven't done one yet. I haven't needed to, but I do have some degree of horse sense in putting together a deal, in walking a property, and knowing, hey, I walked a multifamily property with a potential GP a couple of months ago, and the GPs didn't know to look for stuff. I'm like, okay, these water heaters are at the end of their life. You're gonna have to replace most of them. The TP valve is dripping on 5 of them. We need vinyl plank flooring in here so it's not gonna swell. And there's stuff that after you're a landlord and you've done some of the work yourself, you realize walking a property, it's going to be a problem. So I'd be a good addition to a GP team, but I would need somebody who's experienced in all aspects of it. I could also be part of I have a net worth that's in the millions of dollars. So I would be a good contributor to just a balance sheet to get approved for a loan. I've considered being a limited partner as well, but I'm not like a doctor or a dentist. I do have some value to contribute to a syndication above just the completely passive limited partner investor. And in terms of what would pique my interest, probably a syndication in the southeastern United States. So Georgia, Florida, South Carolina, North Carolina, maybe Tennessee. I think those are areas where we stand to gain both equity inflation and also strong cash flow if you're purchasing right to begin with. A lot of areas you're trading one for the other. Some people have argued Midwest is high cash flow, but not high appreciation. People say West Coast and Sun Belt, high appreciation, but not high cash flow. I still think if you're buying right, the southeastern United States is the place to buy. So
Beautiful.
You can make mistakes and still be floated up by the general market trends in the southeastern United States.
Excellent. And that was my next question, was as far as buy box. And it sounds like in your part of your career, it's similar to similar constraints that I have. Me being the internet guy, I got to make sure that there's enough money floating around to outsource the operations piece. Make sure you get a third party operator. So that means you got to be like 100 units plus. But just so you know, when commercial real estate investors talk to each other and say, hey, what's your ideal property? What's your buy box? We're really looking for the geography, which Bryce already said. We're looking for the unit count, and we're looking for the class, which is both the condition of the building and it's A, B, just like in school, B plus, B minus, that sort of stuff. And then the other one is the proximity to schools and crime rate and stuff like that. Both of those are called class. But as far as unit count and class goes, what do you prefer people bring to you?
Well, you're right. I think if it's anything less than 100 units, the property management won't pencil out. You'll be paying too much per door for property management. So it has to be north of 100. I mean, this is what every syndicator dreams of, but I would want C product in B area, probably, so that there's a value add incentive. For if you don't know this, that's the best way to make money in syndicating real estate is to to renovate where the rents are going to have a high delta. Therefore, the underlying value of the asset's going to chase that delta. And you can usually do that in a place where maybe comparable rents are higher than the product that you're buying. And the difference is not in location, but the difference is in condition of the actual asset. So, yeah, beyond that, it's just making it happen. You really, to renovate a big 100-unit apartment complex like that, you need a really good general contractor, and you need somebody to manage them as like a project manager and push. Even in my small stuff, the one lesson you learn is every renovation, there has to be someone who's the locomotive behind it. It can't be the drywall guys. They're not going to finish it on their own, and they don't have the maybe motivation to do it. There needs to be someone with emotional buy-in who is stepping on the gas during every stage to take it past the finish line. I don't even know how to quantify that, but I know that it's real. You need somebody to push a renovation past the finish line.
Excellent.
Sometimes that's the KP because they've done it before and they know what it takes and when to push hard and everything. But I've done enough of them on my own. Like these renovations are worthless until they're finished.
Right.
I can't rent a 90% completed unit. That's worth zero. It's worth as much as if we hadn't renovated it at all. Yeah. So you got to finish the product and get it to market for it to be worth anything, and to keep your cash flow from deteriorating.
Beautiful. Yep. Bang on. So if somebody is in the audience in the camera there and they think you're a perfect fit, what's the best way to reach out to you? Like I found you through the Bigger Pockets podcast, and I bugged you that way. Usually I spend all my time on LinkedIn. Is LinkedIn a good way to reach you, or is there actually, I looked for you. I couldn't find you that well. So
yeah, because I'm not on LinkedIn. I've been out of the career field for so long and I haven't done my own syndication. I just felt like I don't need to be on there yet. My best man / coach though tells me I need to set up a profile soon. You can just shoot me a straight email. I'll give you my Gmail. It's Bryce Stewart, which is BryceStewart 79 @gmail.com.
All right.
Shoot me something and we'll have a conversation, see what we're looking at and if it's a good match.
Excellent. And there's only one thing left, which is actually for you in the camera, which is don't do this too suddenly, okay? Because like you might hurt your eyes. Under my left hand here, you'll see this red button, and it's ugly, and I hate it. So I think what you should do is you should click on it and turn it gray, because that's the pretty one. The gray button is awesome. Just try it. It's amazing. Just hit the button and it turns gray. And what it does, it has this great power. What it does is it means that YouTube will start paying for these videos instead of me. How cool is that, right? And it costs you absolutely nothing. There's no credit cards or emails or any silliness like that. All it means is that these videos might show up on your list of suggestions, but you don't even have to watch those because you've already done me an enormous favor. Just like Bryce, you've done me an enormous favor by joining me today. This has been fantastic getting to know you better.
Thanks so much. Yeah, subscribing is a pretty one-sided cost-benefit analysis, right? Costs very little, but the upside could be potentially huge.
Exactly. All right. Thanks a lot, man.